And then we go to the N. And the N really means the nurtured relationship. You feel like you've been heard and healed and helped. But the concepts in there really allow you to move a little bit forward, where we're able to make sure that you understand everything that's out there. And we're challenging some of those limiting beliefs that you have. And we start this process of moving forward. And so these concepts, the concepts that fall under the N, are really around accelerating your wealth building journey. And then how do we move forward? One of the ways that we can do that is by investing in stocks, right? They represent ownership in a company. There's a ability for these investments to grow because they are companies that sell products and services and do so on a regular basis. And so I want you to think of stocks as having ownership in a company, right? You own this. And so you're able to make decisions and vote and also be a part of the gains that are there. You can share in the profits. And bonds are different. Bonds are a form of security that's debt. And so you are loaning your money to somebody. The most common form is like what we would see a government bond, right? So you're loaning your money to the government, and as a result of that, they're going to pay you a stream of income, and they're going to call that interest. And so whereas we seek out stocks to appreciate our wealth, when we actually achieve a certain amount of wealth, we look for bonds to provide us that steady stream of income that mutual funds are by far one of the best savings vehicles that's out there. It allows you to pool various types of investments, have very high diversification, and as a result of that, have several degrees of risk that are very palatable for a lot of people. And so mutual funds can be this ideal savings vehicle for a majority of folks just because of the way it's able to collectively diversify both stocks and bonds into a portfolio and then just let you buy into that. And there are different types that allow you to invest based on your own preferences or where you think you will be the happiest or have the most involvement. There's also what we would call an exchange traded fund, which is nothing more than a mutual fund that's treated like a stock. Mutual funds in general are good savings vehicles. They're only priced at the end of one day, and you don't expect to have a lot of trading in them. You just put a lot of dollars in them. However, if you wanted to treat a mutual fund like a stock, you could do so with what's called an exchange traded fund. And in that case, it moves throughout the day. You're able to trade it at various times throughout the day, and it doesn't just have one closing price that it has to mark as its going price for the day. We then have index funds. And so often you will hear about how the market's doing. And so they may reference the Dow Jones or the S&P 500 or the NASDAQ. And so think of an index fund as as a mutual fund that basically follows one of those indexes. So it's a mutual fund that looks and has a lot of investments that are in the Dow Jones or in the S&P 500. So there's a S&P 500 index fund. That simply means that it's a fund that's comprised of everything that's in the S&P 500 index. So as you see on a day in and day out basis that the S&P is up or down, that's how your portfolio is doing on a regular basis. It's passively managed, which means we just copy what's going on in the index, and there's really no active management of that. Dividends happen when you are either shareholders of a mutual fund or of a stock, and it's where you actually receive a portion of the earnings. And so if a company is doing well or a mutual fund is doing well, they can pay you a dividend or a stream of income. And that's how we can actually use our investments to generate income for us in the future. Capital gains are what we all hope to achieve. It's the profit that we are expecting from a stock or a mutual fund. But if it goes up, that just simply means we have to make sure that we pay taxes on it. And so a capital gain is usually just a profit that you get from selling investments at a higher price. Right. So if I buy a stock, I buy a mutual fund, or buy an ETF, and it ends up going up in value, yay, I make money. That money that you make is called a capital gain, and then you'd also be taxed on that capital gain. And then as you start to think about what you're doing with your investments. How do you actually grow your wealth? What happens if you if you die, if you pass on, and then you want to ensure that your wealth actually follows the instructions that you want for your wealth to transfer to your family or to organizations. We would put that information in what's called a will. And so it's just a legal document outlining how you want to have all your assets distributed. And so if you're buying stocks and bonds and mutual funds and ETFs, like what do we do with all that in case you die? And then there's also trusts. And so trusts are just arrangements, and think of it as you can set up specific companies just to put some of your assets in. And so we can set up trusts to put stocks in, we can set up trusts to put real estate in or precious metals. But trusts are just legal arrangements or entities that allow you to store assets as much as you can. Then we have what's called a power of attorney. And a power of attorney is usually what happens when you give financial decision-making authority to someone else. And so if you work with a financial advisor or financial consultant, you have an account, it's your account, it's your money, but you can give the control, the financial decision-making to someone else to go in there and place the trades for you and manage the assets. And so it's your account, but a power of attorney allows you to give control, designate someone else to actually make those financial decisions for you. And in a similar way that a power of attorney can do that for your assets, a health proxy is something that can be used to allow someone to make medical decisions on your behalf. And so the combination of not only having something that's good like a will or trust or being able to have something that speaks on your behalf like a power of attorney, also having a healthcare proxy to have someone speaking on your behalf for your medical decisions is incredibly important. Sometimes we don't think about the concept of frugality, but it doesn't mean cheap. It just means that we're actually having more mindful spending, right? Conscious spending, mindful spending, purposeful investing, purposeful saving, outcome-driven types of actions. And it just means that we know how to take our time and take our pace. And it doesn't mean that you're cheap. It just means that you have a plan. And frugality helps you achieve your plan a lot sooner than if you did not practice frugality. And then an important tool to help you grow your wealth is the credit card. Sometimes using cash is not something that's possible, just depending on how often people get paid and how frequent their cash flow is. And so credit cards allow you to conduct transactions and experience revenues on a day in and day out basis without having the physical cash necessary. And so it's part of that ability for you to grow your wealth is having some flexibility to use designated credit at your disposal when it's needed.